As an entrepreneur or as a businessman, you're trying to see where's the best return on your time, right? So we always have so many opportunities that are pitched to us and so many opportunities available. But now it's like our job as business owners is where is the best use of our time or where we're going to get the biggest return, right? So like everything's going to make you money. It's just like how much is it going to make you, right? So
yeah. I feel you with that, man. And I think as you grow, it's like you are presented with more and more opportunities.
Yeah.
And so you got to be more and more selective. All right, guys, welcome to another episode of The Report. Today, we are back in the studio here in downtown San Diego, and we got another Beers and Deals meetup after this podcast. And I got a guest who is visiting from Hawaii, who has a fix and flip business and is actually buying commercial properties out in Kansas City right now. I got my man, Daniel Kong. Daniel, welcome to the show.
Thank you, man. Super stoked to be here. Yeah, pumped for the show.
Man. So what part of Hawaii do you live in?
In Oahu, the island of Oahu in Honolulu.
Okay. Yeah. What part of Oahu?
It's called Kalihi. I'm not sure if you're familiar with it's kind of like in the middle of Honolulu, right there in the middle, yeah.
In the middle of the island, so it's not on the coast or anything like that.
Yeah, but then the thing is, like in Hawaii, everything is like near the coast. So I'm like 15 minutes from the ocean. Like anywhere in Hawaii, you can hit the ocean like 10 to 15 minutes.
Gotcha.
So, yeah.
I was recently out about 3 or 4 weeks ago out in Kauai.
Okay.
And I've been to the Big Island now. I've been to Oahu, Maui, and then Kauai about 3 weeks ago. Most beautiful island I've ever seen.
You must have seen a lot of chickens there, right? It's like they call it the chicken island because there's just so many chickens everywhere.
Dude, I'm so naive. When the first time I saw the chicken out there, I was like, oh, is that a turkey? But it's chickens.
Yeah.
Chickens turkeys and chickens look similar, no?
Yeah, a little bit. I mean, kind of. A
little bit. Yeah. Are they on all the islands or just Kauai?
I mean, they're on all the islands, but I think Kauai is kind of known for it just because they run rampant all over. So
my favorite part of Kauai was like literally just doing a helicopter ride and like going all through the island.
It's super beautiful, right? There's gorgeous scenery and like it's just I think they call it the Garden Isle just because like there's just so much greenery everywhere. So,
it was the Nepali coast and then touring the Jurassic Park. I forget the name of the waterfall.
Yeah.
And then they had the Grand Canyon of the Hawaii Islands out there. I forget the name of that, but wow,
super nice,
it was the most beautiful piece of land I've ever seen in my life. Like not just Hawaii, but like in the world.
Wow, yeah, no, it's super nice out there.
Yeah. So tell me what you guys are doing out in Kansas City with the commercial space. I'm very intrigued with what you guys are buying out there.
So I mean, just looking back at like in our last kind of like what we've done so far is we're fix and flipping in Hawaii. We got kind of like pretty good at it, and then we're just looking at what's the next biggest opportunity. And so what we're doing in Kansas City are buying commercial buildings, and these are office retail. And the whole idea is just buy value add and just like basically burr these things. So buy them at a discount, put some like re-tenant them or put whatever TI or things that need to be fixed up, and then cash out on a cash out refinance to continue to keep that and hold it as cash flowing property.
What's when you guys say value add in the retail and office space? Is it typically picking up properties with vacancy and then leasing out those units, or is it raising the rents, or is it a combination of both?
So it's usually a combination of both, but 90% of the ones we've done so far is just taking vacant buildings. So I think like the big value add over there is just like there's landlords are just like really mismanaging these things, and then we can come in and just re-tenant them or just get the NOI up and running again. Then there's like a huge value add just to that play.
Mm-hmm. Okay. And how big are these buildings that you guys are buying? Like how many spaces? Are they called spaces or are they called units?
You call them, I'm not really sure. Like you kind of go by like square footage. That's like the big thing to kind of how to measure these things. But I mean, we're buying so the two we picked up so far, one is like maybe like 15,000 square feet. The other is like 40,000 square feet across 4 buildings. So yeah.
Wow.
Some pretty decent sized buildings.
Yeah. So I know like with this office space we rent here, it's 2,300 square feet.
Okay.
And we pay $6,700 a month. So it's about what? $3? Is that about $3 a foot? Ish.
I'm not sure. The way we kind of like measure it, I guess when we're as an investment side is like you measure it per year.
Okay.
So I mean like when we're calculating square footage, is like off the top of my head, so you take the 6,700 times it by 12 and divide that by
the square footage.
And that's kind of like what we call like the price per square foot on the commercial side.
Okay, got it. And so I'm just trying to like get a gauge of like, office space here in San Diego.
So let's do a quick calculation. So we're doing
out, man.
6,700 square feet. 6,700 a month.
Yep, 2,300 square feet.
6,700 a month times 12 would be $80,000 a year.
Okay.
Divided by 2,300 square feet. Mm-hmm. So you're looking at $34 a square foot over here.
Okay. That's like pretty affordable for downtown San Diego, at least in this neighborhood of Little Italy. Because when I looked on LoopNet, a lot of them are between 40 and 60 a year.
So I mean, like, so you guys are in a big city like San Diego. The price per square foot is very high. The ones like our ARV on these guys in the commercial space, the 40,000 is $8 a square foot. So like that's like how much per year. So like 35. So like after we fixed it up and tenanted, we wanted $8 triple net. That's what we wanted to get. So.
And we're 34 here.
Yeah, so it's pretty crazy.
So it's about 25%.
Yeah, something like that. Yeah.
Okay, interesting. So, when you're picking up a property out there, how vacant are these buildings? Completely empty, or are they just like 50% occupied?
It really it's like project to project, right? But I think that the ones we picked up so far are about like a quarter occupied, and so we're just like basically they're like badly mismanaged. Like there's no marketing. All of them have like a little story to them, but we basically come in, we fix all the problems that are happening in the building, and then just get them like up and running again. So
What does the lending look like if these properties have 25% occupancy?
So lending is very hard to get on these kinds of buildings, but we have like a contact in Kansas City that works with the local banks and kind of goes to bat for us. And we have a bunch of other guys who are doing this like buying the same area. So we kind of have some like clout or some like a good reputation. And so because of that, we're able to actually get lending. So I think we got like 50% LTVs on some of these purchase prices. So
50%?
Yeah.
That's not too bad.
Which is good for like a quarter vacant building, like, so.
Sure. And so once you stabilize them, and how long does it take to stabilize these types of assets?
So we're in the middle of two right now. One of them took about 8 months to stabilize. The other one has been 6 months, and so we took it from like 25% to like I said 85% now, and hopefully in the next couple of months we'll get it up close to 100.
Yeah. Are you guys renovating these properties before you lease them out?
Not, I mean, like, so when you're leasing out the space, like it's like space by space. So like we're doing like a very minimal, like as far as like curb appeal things, just because they're already in great shape or decent shape. But then like so each, like, cause like when you have like a commercial space that you're renting out, there's like the TI. So sometimes when you're bringing in new tenants, you have to partner. So I'll put in like 50% of like the tenant improvements, and then the tenant will put in like 50% or whatever you guys kind of work out together. So we are putting in TI into some of these spaces.
I see what you're saying. Now, if you were to renovate the property, like maybe some like the common spaces or like exterior parking lot landscaping, that would be on you guys. But you're saying when you lease out these units or spaces to tenants, you're giving them some sort of TI allowance, tenant improvement allowance. Is there a way to calculate like what type of TI allowance makes sense for you guys as the landlord?
It's so like, it depends. Like, like it's how much are they going to build out? How long is their lease going to be for? What kind of tenant is it going to be? So when we have like, let's say an A-class, like an anchor tenant, like a Starbucks or like a Five Below or something like that, then we'll be willing to put in like more into the space because we know that they're going to be there for longer, or they're going to bring in more other tenants who are like, just because they're the anchor tenants, like if they add more value as a tenant than like a regular mom and pop, right? And so it's kind of like a case by case basis depending on the tenant and like kind of like what they're willing to sign as far as like the terms and like the length of the lease.
So what kind of like neighborhoods are you guys, buying in? Are you guys buying in areas to where there's Starbucks and those types of customers are going in, or are you buying in areas to where there's like laundromats and like pawn shops?
I mean, it's kind of all over the place, but the big thing is like, I mean, the commercial office retail, I think overall is kind of considered risky. So you look at like these large office spaces that have like a ton of like vacancies. That's like very risky because just people are moving away from the office. And so like large office is just like, is not desirable right now. But like you look at like the little smaller like strip malls or these things where there's like, they call them like anti-Amazon shops, where like you can't buy it on Amazon, like a hair salon or like restaurants or these other kind of things. They're like a little bit more as quote unquote safe. But even within that space, there's like the location in commercial buildings is super important. So like when you're looking at a residential property, like if they're like right next to each other, whether it's behind the main street or on the main street, is relatively the same price, right? But in commercial, like your street frontage, how much actually like cars you see that go by the property, or how much foot traffic you get makes a big difference as far as how easy it is to rent out and how valuable it is. And so we're kind of sticking towards things that we know are going to be like very valuable or easy to rent out in the case of a recession or when things are not going so well. So,
yeah, that makes a lot of sense. So things that are not replaceable through Amazon or maybe AI.
And then centrally located things. So like one of the ones that we're buying a strip mall right now is like right behind a Walmart. So like you want places where there's going to be like, there's already activity, right? So you have like foot traffic, you have people who are already going there for other things. And so like so far, all the buildings we bought so far are like either right across from a shopping center or like part of a shopping center. So
What about a barbershop? Is that considered like low risk in terms of like not being replaceable?
Well, when you're buying these buildings, you're not really buying the business. You're buying like the building, right? So when you look at the building, like every kind of building has like different kind of uses that it can be used for. So if you take it like, let's say like a barbershop, for instance, let's say the barbershop were to leave or vacate, what could you fill the space with, right? So like as long as the space makes sense, like it's not funky or like laid out just only for a barbershop, right? Let's say you can put in some TI, you can get like, let's say like a massage place, or you can get like a just an Amazon store, something else that could replace it. As long as it's like a normal kind of like space, then like it doesn't really matter if it's a barbershop or whatever it is. And so
my barber, his name's Oscar. He's like the best barber in downtown San Diego, and he works at a shop in East Village. And I would the East Village is about 10 minutes from Lit Italy. It's on the other side of downtown. And I would go in there. I go in there like every Friday. I was going in there every Friday. But it's like this guy's the best barber in town, so his schedule is always booked up.
Yeah.
And I would spend like 30 minutes driving there or taking a ride there, and then cut 30 minutes back. And so in half the time I couldn't even book him. And so I'm like, now I'm stuck with someone else. And like, that's like the luck of the draw. You get stuck with someone else. They never cut your hair before. And so I was like, Oscar, what are the chances that you could come over to my office every Friday at 11 o'clock in the morning? He starts his shift at like noon. And so he comes in and he's like, I'll pay you $150. And then you can go into the shop after. And he's like, dude, I'd love to. So he comes in here every Friday at 11 o'clock. It saves me like an hour at a time, and he makes a little bit more money. So it's a win-win for both of us.
I love that. I mean, like that.
Yeah, but dude, he's the best barber in town, and like he really wants to open his own shop. He just doesn't. He doesn't really know where to start in terms of like leasing up a space and marketing and that sort of thing. But in terms of like operating the haircut business and all that, he crushes it, and he knows all the best barbers in town, and so he could bring in the best barbers. And so I thought, man, like, what if we did, because I've lived in this particular neighborhood, Lit Italy, which is like the trendiest, like hottest neighborhood in San Diego. I've been here for like 7+ years now. So I really understand it. And there's like no good barbershop here. And so I thought, man, what if I went in with him, he can run the haircut, the operations. And then I'll just, I'll find the spot, have the vision, run the marketing, and that sort of thing.
I think it's genius. And so I think when you see a lot of these guys, like they're really good, like a barber, he's really good at being a barber, but he might not have the business sense or like the marketing knowledge, right? So you marry the two together where you got a guy who's like a super good operator in their craft, and so they can crush it in that side, but they don't know how to get the word out, or they don't know how to do those things. So like now they take a person like yourself, maybe a little bit savvy on, how to negotiate the lease, how to set up the terms correctly for the barber. And then also you can manage, like, let's say like put up posts on your social media, kind of get him to drive traffic, manage his Yelp page or whatever, those kinds of things. And now you've got like a kind of a match made in heaven where he can run in his lane that's really good. You can run in your lane, and together you guys can make a lot of money, I think.
Yeah, absolutely. That's what I was thinking. I was thinking, well, what if we went like a little bit like higher end? Like let's make it a super trendy spot. Have like really cool loud music. Employ like a couple cute like girls to work the front desk, and then like guys come in, they will they sit down, wait, give them a drink, maybe like a beer or a glass of champagne, sit down and wait, good music, just make it a cool trendy spot, and like have the best barbers in town, and instead of charging $35, $40 a cut, let's charge 100.
100 and 100%. And the thing is, it's all about like perceived value too, right? So if you're in an area where people are affluent, they'll be more willing to pay money for a haircut. And then another thing you can add to it is maybe a second service where like, hey, we'll come to your house for like $200 or something along those lines, right? Because now it just make sure it's worth the time for him to travel out. But then like, and if it's, you keep on raising the price until like there's not enough, or the demand is right, or keep lowering it, whatever makes sense. But then like for me, like I would happily pay for somebody to come to my house if I know like he's like a good barber. And now that you're in San Diego, you got like see some of these other ballers and stuff. There's like the 200 or 100 is like, it's like, it doesn't really matter as long as you're saving you time and convenience. That's what we really care about, right? So
that's a good idea. So maybe that could be like another arm of the haircut or the barbershop.
That's why I've got a buddy. He's like, he runs like or he owns a couple of laundromats, and so like the laundromats is like from 10 a.m. to 10 p.m. there's like a regular laundromat.
Okay.
But then people can drop off their laundry there for the self-service. And then from 10 p.m. to 10 a.m. they're washing all the laundry that's been dropped off. And he said the margins on the dropped off the dropped off service is way higher than the actual laundromat itself. So if you look at, let's say like this client where you build up the clientele where let's say you charge $100 a head for like the in-person, like they drive to you, right? But say like, hey, for $500, we'll come to you and give you like a haircut wherever you're at. So the price is a lot higher as far as the margin is concerned, but it's still worth the time for the guy to go out there. But because he has a brand and everything, and the people who are like let's say like if you make a lot of money, like your time is very valuable. So as opposed to you driving there and doing things, now you have the people come to you. It's a win-win for everybody. So,
yeah. What do you think that would cost in terms of like a build out to lease a cool spot? It has to be in a great location.
Yeah.
But to do a build out for like what I mentioned, we're thinking like, you know, he said ideally probably you want like 8 to 10 chairs.
Okay.
And so you're going to need probably plumbing. You're going to need good lighting.
Yeah.
And then, you know, obviously make it like a cool, trendy vibe with good music and like probably an area that people can like hang out and wait, like a good waiting room.
I mean, the thing is like, it's so subjective to your area. And so like, to give you an example is when we were talking to some of our friends who are flipping in Vegas, like they pay like $60 a square foot for luxury build out in a residential. But for us, like just a basic residential thing, we're paying like $125 a square foot in Hawaii for average. And so I imagine San Diego is probably going to be very expensive, like as far as like the price per square foot, just because the cost of labor and the materials in Hawaii is just kind of like out of control. So I would just without knowing your market, guess like 150, 180 a square foot, just to be like a huge guess. But if you can find something that's maybe already has plumbing, like let's say like a hair salon that we can convert or something along those lines where it's already lined up similar and you can kind of just tweak it, that might also save you some money too.
That's a good point. Yeah, because if we could find that, probably cut it in half.
Yeah.
Interesting. Yes, I don't know. I was thinking about it, and he was kind of telling me that some of the numbers and that sort of thing. I don't know if it's something that I'll pursue, but you know, I really like the dude, and I kind of want to help him out.
Yeah.
But I got to make sure that it's not going to take up too much of my time.
Yeah, that's another thing too. Is like as an entrepreneur or as a businessman, you're trying to see where's the best return on your time, right? So we always have so many opportunities that are pitched to us, and so many opportunities available. But now it's like our job as business owners is where is the best use of our time, or where we're going to get the biggest return, right? So like everything's going to make you money. It's just like how much is it going to make you, right? So
yeah. I feel you with that, man. And I think as you grow, it's like you are presented with more and more opportunities.
Yeah.
And so you got to be more and more selective.
I had a coaching call or a coaching session with Pineda actually the other day, and just looking at some of the different opportunities that we had in front of us. And he said like, hey, whenever you're looking at an opportunity, the new opportunity can never be like the same as the one that you're making now. Like, so let's say like you're making like $1 million a year right now, right?
Yeah.
And you have this other opportunity, you can make $1 million a year. It doesn't make sense for you to spend your time and energy to learn this new opportunity when you're already good at this one. That's already like making you the same amount, right?
Yes.
So the next opportunity has to make you like 10 million or more, because in order for you to switch your focus or your time and energy to do that next opportunity. So just when you're looking at opportunities, there's what's like, the next opportunity just has to be bigger. But there's also like helping your friends, which is like a different like animal, right? So like, if you want to help your friend to start out, that's different than like you're trying to make money off this other thing, right? So
yeah, there's a little like feel good about that, but I totally agree with you. It's like if you're not going to leave $1 million opportunity that's already working to go learn another $1 million opportunity that might take you 2 years to figure out.
Unless it's like it takes none of your time, right? So like there's certain times where it's like let's say like sometimes we'll partner with people on something where we already have a good skill set here, and it's not going to take any of our time to actually like add some value or do this thing just because we're already good at like this scale, and it's only take a small fraction of your time, then maybe it might be worth it for like a small hour to me, just because it's not going to take any time from you, right?
So with these commercial properties out in Kansas City, once you stabilize them, are you guys looking to refi and hold them, or are you guys looking to sell them? If you are a busy professional and don't have time to invest in real estate but still want to participate in the passive income and tax benefits, my team, Summers Capital, is buying a lot of boutique hotels right now. We source the deals, we renovate the properties, and we even do all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. Yeah,
we're looking to refi and hold them. So where's like the BRRRR strategy, right? Like the same with the residential, where you buy the property undervalued, you put in a little bit of rehab, or kind of look at the increase NOI in this case. Then go to a bank and says, hey, like here's that new NOI. Can we get a cash out refinance? And then pay back the private lenders who are on the deal, and then just rinse and repeat. So,
yeah. What kind of cap rates do you see out there in Kansas City for this type of product, just to kind of give us an idea?
So on the exit, it's about a 7.5. That's what we're assuming. So like a 7.5 cap on the exit. Yeah.
Okay. And so what does the debt look like for stabilized stuff out there?
It's 75% LTV. We're looking at like 7.5% right now as far as like what we're seeing on the market.
Okay, got it. And then there's still DSCR restraint.
Yeah, DSCR restraints, 20 or 25 year AM, depending on the.
They want to do 30.
Typically, commercial is 20 to 25, and it's usually a 5-year balloon. So like 5 to 10 year balloon, depending on the lender. Yeah.
Is this typically like local banks that will finance that kind of stuff?
Typically, so that's what we're using. So like the local banks will give you a lot more flexibility and give like a lot more options because they're familiar with the area, and then also like so they know the assets better, and like they have some relationships so we're working with some local guys who have the relationships with the bank to kind of like help us to get these connections and get these terms that we want. So yeah.
I love that, man. So I see you do some Airbnb stuff out in Hawaii and some house flipping as well. Which one did you get into first?
It was actually, so we did rentals, it's BRRRRing, into the BRRRRs turned into flipping. And then some of the flips we went on the exit actually, we're trying to BRRRR everything. But then some of the BRRRRs, they don't cash flow on the back end, so we turn them into Airbnbs in the back end. So kind of basically flipping started before the Airbnbs.
Gotcha. What's the Airbnb market like in Hawaii?
It's really challenging because I think about 2 or 3 years ago, the state or the counties implemented some like really strict Airbnb laws. Before it used to be like the Wild Wild West, like anybody could Airbnb wherever you wanted to, whenever you wanted to. But then they claim it was like the neighborhoods, but it's really probably like some lobbyists from like hotels. Like they don't appreciate like the Airbnb and stuff, right? So basically they shut down like almost all Airbnbs except for a few places in Waikiki and like in the North Shore, and then at some hotels. And so
was that during 2020, like during COVID?
It was around that time, yeah. Like they put in some really strict laws, and so the Airbnb market is very tough to get like a legally zoned Airbnb right now.
Are there certain like neighborhoods within Hawaii that are better than others for Airbnb to where you could legally operate?
Yeah, I mean, so there's only one neighborhood really or like 2 neighborhoods in Hawaii where they're actually quote unquote legal, and that's like in parts of Waikiki. So maybe like 10 buildings in Waikiki are legal. The other like 50 buildings are illegal to operate. But I think Waikiki is a great spot because high tourist destination, high like tourist like count. And then North Shore or the east side where there's a lot more like beach access. People like beach houses and stuff, right? So like the houses that are right next to the beach get a lot of traction because when you think of Hawaii, you think I want to go to the beach and I want to hang out like with my friends at the beach.
Now North Shore, if you get a house with beach access, is that legal to operate?
99% no. Like
really?
There's like a small section they call it in Turtle Bay where like it's within like the kind of like the hotel's boundaries that you can legally like Airbnb it. But the rest of like the beach houses you see like in North Shore, they're all like they're not legally zoned.
Now prior to 2000 when they made these changes, you could legally Airbnb in a lot of parts of the islands.
Yeah, I mean like it wasn't like quote unquote legal. It was like a gray area basically, but like nobody cared and there's no like government like restriction on it. So basically everybody could just do whatever they wanted.
So you guys are finding ways to Airbnb or not all your properties?
We are finding not all of them. Like we have a few that we're Airbnb-ing it. Yeah.
And okay. And you're doing some midterm rentals as well, is that right?
Yeah, a couple of midterm rentals too. Yeah.
What do those look like in terms of cash flow? The midterm rentals, are they more prosperous than doing the long term out there?
Yeah, more like for sure they bring in more than the long terms. Yeah, but it's kind of in between. It's like there's like the long term, then there's like the midterm, and then there's the Airbnb. So the Airbnb will bring in the most money, but then the midterms are a little bit more than the long terms.
Yeah. I didn't realize how because Hawaii is known as a blue state, right? Relatively liberal. Yeah. And I'm finding a lot of these blue states are the ones that are like, slapping on some heavy short-term rental regulations. You saw what just happened with New York City. And then, you guys a few years back, and, California is a blue state. San Diego just started regulating back in May pretty heavily.
It's just a matter of time, I think, before as a blue state, they're going to have like heavy regulations. Happen, right? Yeah, it's just a matter of time.
And that's why we're targeting boutique hotels in blue states and not red states. Because you go in the red states, a lot of them have a lot, less bureaucracy and red tape. And so those areas like, Texas, Indianapolis, even parts of Arizona, it's like the wild, wild west. And in terms of short-term rentals, and there's a lot of them. And so I don't want to compete with that.
That's a huge like a point that you just made. It's just like sometimes it's a pro and a con, right? Because for like as an operator, if you can because like in the blue states, like even Hawaii, there's like permitting is like super hard to get permits for your deals and everything. But if you can navigate it, it actually helps you because like it's such a difficult problem to solve. And so as a boutique hotel, like all the normal Airbnb guys are shut out because of the regulations, but now it makes you stand up even more. So like now you're like a unicorn, or you can like charge whatever you want because there's no other competition around you, right?
Yes. So. Absolutely. And then, to take it a step further, it's like, okay, you got the commercial zoning and the hotel zoning. Yeah. And so, no matter what happens to the regulations, it's like, you don't need to worry about it. Neighbors, it's like these people that buy homes next to the airport and they complain about the airport noise. It's like, say, well, same thing with the hotel. It's like, you can't complain if you bought a house next to a hotel that's been a hotel for 100 years, you know?
No, I mean, you guys got like a good, really good niche going there, I think. So,
Yeah, so we'll see. I mean, you know, who knows where it will go. But I'm just like, okay, there's so many short-term rental investors out there. There's so many short-term rentals in the country. And, you know, if I'm a betting man, more of these cities are going to continue to regulate.
Right?
I
agree.
And once they regulate, they're probably not going to deregulate. You know, and so as this happens, it's going to bring more demand back to the hotels, back to the boutique hotels. And you know, a lot of these small hotels, dude, they're not building them. You know, like they're not building 20-unit boutique hotels. When they build hospitality, they're building these massive hotels. And a lot of cities, they don't want these massive hotels in them. You know, they're massive. They block people's views. And so I think from like a supply standpoint, you know, it's somewhat protected. I'm kind of like mobile home park investing, right? They're not building mobile home parks anywhere. You know, people just don't want them in their neighborhoods. And same thing with a lot of these small neighborhoods. They don't want these big, massive hotels.
So I think you guys have like a really good thing going right now. And so it's just, I mean, the thing about like what you see kind of in like just the investing space in general, I think over the last 10 years, it's just been like you want to stay ahead of the curve as far as like the information, right? So like when Airbnb first came out, it was like blue ocean. Like everybody and their mom you could not lose anything because it was just like wild, wild west, right?
Yes.
And so like it was like everybody in there just made like a ton of money when the Airbnb first came out. And then eventually like the media and like social media came out and like there's more information out. Now everybody and their mom was running an Airbnb, and now there's regulation that's kind of cutting it down. But there's always like an opportunity that's like current, that's right now that other people are not seeing. But then if you're the first in line to jump on it, like now you're gonna have like a blue ocean, like a huge like amount of opportunity. I think boutique hotels right now is a huge opportunity that you guys are jumping into. So
yeah, I appreciate that, and we'll see where it goes. But yeah, it is blue ocean. And then also like the Airbnb stuff had a low barrier to entry. Like you don't even need to own a home. You can literally just like go lease a place in arbitrage,
right?
Right. And so you had this big influx of all these investors. And you know, at least with the boutique hotel stuff, it's a much higher barrier to entry. Like it's a commercial loan product. That's hard to get, right? They don't just hand out commercial loans.
Bigger
to
price
anyone.
Points and stuff.
Higher price point. You're probably going to have to go raise private capital. And you got to know how to operate, right? And so there's a lot more barriers to entry there. I mean, even just to block up a boutique hotel, like, you know, these brokers, they, you know, value the relationships with these sellers. And so they're not going to just let whoever come in and lock it up. But I don't know. We'll see, man. We'll see where it goes. And, you know, I think sometimes you got to zig when others are zagging. And so as I see multifamily get, you know, overheated, Airbnbs overheated, I just think this is kind of like the zig when others are zagging. But also, all those Airbnb investors, the next natural progression for all of them is to get into boutique hotels. So as these markets get saturated, you know, I think a lot of them are going to want to jump in. And maybe boutique hotels will be oversaturated in 5 years.
It will in 5 years,
I mean?
But like, so while it's good, right? Take advantage, right? So I think so.
So I don't know. Maybe we'll be doing some nice exits then, or refining these things. I don't know. Who knows? So how is the interest rate environment affecting, you know, what you guys are doing with your fix and flip business, but also with the commercial stuff out in Kansas City?
I think so. For the fix and flip business, it's definitely like we've seen like a slowdown as far as like it's not crazy like prices. Like I think during that 2020 to 2021 when we kind of jumped into it, like we got very lucky because like the economy was just like was crazy, right? So we thought we were gonna make let's say 150 grand on a flip. We ended up making 250 just because it's nothing to do with our skill set, just because of the market. And then I saw other guys who I thought, oh, they're going to lose money on this flip, looking at their numbers, and then they'll make like $100,000 just because the market was so crazy, right? But now we're kind of seeing the market kind of even out, and so like for us, there's like smaller profits as far as what we're seeing, and then just overall, just like it's a tougher market to navigate on the fix and flipping side. And so actually, some other friends we know so we took our first loss this year actually as a fix and flipper.
Where?
Is in Hawaii in Manoa. Okay. So
this year, what happened?
I mean, long story short, there was a bunch of mistakes that have been made. I mean, like number one, I mean, there's a bunch of mistakes we made, but like it would have been solved if the market was normal. But the market dipped right in at a time when we were like, we're gonna sell the property, and so like that was like a huge like negative for us. And so we took a small loss on that one, but it's just like that. A big part of it was because of the market shifting, I think. So
yeah, are you guys seeing a decline in like median sale prices out there in Oahu?
A little bit, yeah. It's like yeah.
We're not really seeing that here in San Diego. There's just no inventory. No one wants to sell their homes, and even though interest rates have doubled, I think the inventory is low, so we're not really seeing a drop off in pricing.
Yeah.
Which is, I don't know.
I think
it's
like
kind of intriguing to me.
the median single family homes in Oahu like a little while ago was like 1.1. I think it's like 1.0 like 5 or something. So like it is like a small drop, but not a huge drop. So
gotcha. And then what about the commercial side? Are you guys being affected there with the lending environment?
I mean, so when we jumped to the commercial, it was kind of like the environment was already like that. So I'm just like, I don't know how it was before. So that we're just like, we're playing in that environment as is, basically.
You guys have partners. Do you have partners in Kansas City locally? Or are you guys doing this all out of state?
So we have like a team, like contractors, we have like brokers, we have like property managers that we partner with. I mean, they're vendors, right, to us, but basically like they're kind of like the boots on the ground for us to kind of do our deals. And so like, we'll take trips to Kansas City to look at the commercial properties ourselves. I think in like residential, it's not as important to actually look at the property because, okay, you can just see it on Zillow and like, this is what it is. But then in commercial, like the frontage, the vibe, the feel, all these different kind of nuanced things, like how many people like drive by. It's very important for you to, in my opinion, to actually see the property and like the surrounding neighborhood to really get a gauge on how easy it will be to lease up or what kind of value you can actually add to it. So.
Yeah, that makes a lot of sense. I've always wanted to own like a mixed use building where there's maybe like some retail on the bottom and then a couple maybe like multifamily units up top that we can operate as like short-term rentals. I always thought that would be kind of a cool play.
I mean, there's definitely like, so we're looking at a bunch of deals that have that right now. The one problem we're running into when we're trying to buy these things is the sellers, like they're using the NOI of the Airbnb, but then it's not a legit, like we can't count that income as is, like, because what if the regulations go down, et cetera. And so they just overvalue the properties when they're already Airbnb in it, which is like something. But the other thing too is like the good thing that we really like about the commercial properties is they're very low management once they're stabilized. So when you look at let's say a multifamily property, it's like when you say, hey, I want tenants, they're like, it's super easy to rent them up because there's hundreds of like applicants who want to rent that space as long as it's priced right and the property is good, right? But when you look at a commercial property, you're gonna assume 6 months to like 2 years to tenant the spaces because there's just way less commercial tenants who are gonna tenant your building. So the lease up is a lot longer to lease those things up. But once it's stabilized, triple net, they take care of like their own repairs. Like you're not dealing with any toilets, and typically leases are like 2 to 10 years. So you have like a 5-year lease in place, and so it's very stable. They take care of like the taxes and like the insurance if it's triple net, etc. And so like the management of like a commercial property with no residential units is a lot easier than if it has like a mixed use as far as commercial and like residential.
Yeah. What's the biggest risk to buying these, high vacancy office and retail spaces? Hey guys, real quick, the only way this podcast grows is if you guys share it and review the show. So if you do find value, if you could take 2 seconds and drop a 5-star on Spotify or Apple Podcasts, it would mean the world to me. But more importantly, it will help us reach new audiences and help more people build wealth through real estate investing.
I think so. When you're looking at commercial, there's such a wide variety of commercial, and like the risk is like all over the place. And so we talked about, I think like the large office space, huge risk because like people are not going to office. Like it's just not a desirable place, but you're looking for something that's is going to be basically called like Amazon proof, or like, okay, like when eventually Amazon is going to take over the world, it's not a matter of if, it's just a matter of like when, right? And so like the things that are like competing with Amazon, those kind of businesses or those kinds of things is not a great long-term play. But things like barbershops or restaurants or things that are like, let's say like hair salons, those things can't really be replaced by Amazon. Those are kind of things that are going to be stable. And then you're looking at places that are like going to be desirable as far as foot traffic or like vehicle traffic, because so like when you look at like a commercial building, there's like, let's say like there's 3 commercial buildings like right next to each other, right? The guy who's like right on the main highway trafficking, where they can see the signage, the frontage, and they're going to get the foot traffic, that's way more valuable than the guy who's behind and who the guys that are right behind, even though they're right next to each other. And so they might rent for a similar price per square foot in the beginning, but in the case of a recession or things are going down, the guy in the front is going to have a huge advantage as far as like what people who want to stay in this one as opposed to the others. And just like when you're looking at like the locations, like you want to look at the demographics. If it's a small city, like you're always worried about, okay, is a city going to be like declining? So there's a lot of like nuanced things for this, but basically you want like somewhere in like a big city in a general place where there's a lot of other things that'll draw, like let's say like a shopping center or movies, etc., or restaurants. And so like you're in a place where there's a lot of traffic, and then a place that's going to be hopefully be like still have people going there in the case of a recession or like in a downturn. So
yeah, that makes sense. And I know In terms of like recession-proof asset classes within commercial real estate, you got multifamily, mobile home parks, industrial. I think those three, and self-storage probably are the four that kind of lead the way. I know hospitality is definitely considered like a higher risk asset class. Retail, office could be, I don't know. But there's always ways to make it work, right? I heard that like, Grant Cardone was on the show and he's been buying like a bunch of Class A office.
And
like Scottsdale and like the nicer stuff.
Yeah.
And he was saying that he's found success doing that because he'll pick up like you guys, he'll pick up, high vacancy Class A office, but in like really core locations where a lot of companies want to go work. And then he'll put like a Cardone Capital office in there. And he'll go on social media and just be like, hey, who wants to come work in my building? And then he'll just like lease up the whole building like that.
He's a master marketer. So like, so I mean, they call them like anchor tenants, right? So like, let's say you have like a building that's like just vacant, right? Like then you put a Starbucks inside here. Okay, now the Starbucks is super valuable to your building because everyone knows there's going to be traffic from Starbucks or like a Target, right? So like because you're next to like these anchor tenants, now everybody else wants to move in because they want, as a business, you want something that's going to have traffic, right? So like let's say your buddy has like the barbershop, right? If he moves into a place like right next to Target, he's going to get way more like traffic or like free customers than it was in like a remote place that doesn't have like a Target, right? So like it's just but in Grant Cardone he's his own massive, like he's his own entity, right? So he puts himself in there, like now he's gonna attract the other tenants because they want to be near where it's happening because of him himself. So
what about the idea of like a co-working space? We're seeing a lot of co-working spaces pop up, but kind of a hybrid model. I know one of the guys in our mastermind, his name's Shane. He really wants to do this model at some point, but basically like lease out an office space, make it into a co-working space, but add like a really cool podcast studio, add like a gym, and have like a content area to where, a bunch of entrepreneurs could come in there, rent the space, but also have like a production room. They can shoot podcasts, they can shoot content and all that sort of thing. I thought that was kind of intriguing.
It's funny, I actually have two friends on Oahu who just launched their own, this exact same model.
Really?
So like they open up a co-working space, but there's a podcast room and there's like a conference rooms for like events and stuff. So like they just launched it actually very, very recently in the thing. And
how's it going so far?
So far, so good. I think it's a great idea. The one thing is like as a commercial real estate investor, like you're more concerned about the building and the location than the actual like the running. So you don't really want to run businesses out of it. So like if you're doing the podcast or the co-working space, it's more of a business. And if you if you get the building as well, that's like a different like kind of business model. But we're looking at we care about the location and the business. I mean like the location and like doesn't matter what the business is inside of it. It just matters as long as it's. Let's say the business goes under, we can tenant with like another business kind of, so.
Absolutely. I always thought it would be cool to like have a commercial building, but also own the business in one of the units or one of the spaces and then lease out the others. For example, like a 4-unit strip mall and like have a laundromat business in one of the spaces. And then rent out the other 3 to tenants. Like I always thought it'd be cool.
There's actually like a strategy to that. So I mean like, I'm not a CPA like tax guy, so don't quote me on this. But basically, like the strategy that I've heard pitched to me is like basically like you buy like a building that's like vacant or is like in distress, right? Then you take it on an SBA loan on a business loan, and as long as you own like 51%, you can get like stupid financing on the business with the purchase. I mean, so you purchase like the building with your business, and then you run the business out of like 51%, and you get all these benefits as far as like loan and tax savings and things. And so,
dude, they'll do like 85% LTV,
it's like 90%, I think, right? So and so like, but then like as long as you own like 51%, and then you lease out the rest of the things, right? But your business is like that. You yourself are the anchor tenant, so you can charge whatever you want for your business. There's a lot of ways to kind of like to play with it to make it creative, but like marrying the SBA with like the commercial loan. So
yeah. I know SBA will do like boutique hotels. But dude, it's so many hoops you got to jump through. It's like, you need to get approval from the SBA. You need to get approval from a CDC, and all these other like hoops you got to jump through. I think it's actually like not too bad if it's just you and you don't have a lot of like assets and like a big real estate portfolio and there's no investors. I think it's relatively simple, but if you are taking down a bigger deal, and you're going to raise money, they want to see like bank statements from all the investors involved and all that stuff. It's a lot of layers. And then it could take 4 or 5 months. But I've always thought that would be cool. And maybe the co-working space podcast studio, probably something that I won't do in the near future, just because it doesn't sound like it's going to be a good return of my time. But I always thought it'd be a fun idea to think about.
No, definitely, I mean, like, and my friends who are doing it, like I think they also enjoy it too, right? Because they can like design how they want and like they have their friends be like some of the members and stuff and like have a cool setup. So yeah.
So where do you see the most opportunity moving forward as you kind of look over the next couple of years? You're in the fix and flip industry, you're doing some Airbnb stuff and you're doing commercial stuff out in Kansas City.
Yeah.
Where do you see the most opportunity as you look out the next couple of years?
I think so for me, I think I see a ton of opportunity in the commercial and in the multifamily space. I think just because like on the fix and flip side, like there's only so many deals you can do to kind of hit a cap as far as what you can make. But then on the commercial or the multifamily side, you can always do bigger deals. So like right now, like our average like deal size we saw for in Hawaii is maybe like a $1.5 million on the exit, right? You make like $150,000. But then on the commercial side, for that same like one deal, you can buy like a $5 million, $10 million building. And then like the spreads and the things that are involved in that, like I think it's a lot higher. So then like it's easier to scale just like higher price points on the commercial and the multifamily than it is on the single family. So I think there's a bunch of opportunity. And then with the market going down, there's like going to be a lot of distressed sellers and et cetera. So there's just going to be, I think, a ton of opportunity in the multifamily and in the commercial space coming up in the near future.
What about interest rates? Where do you see interest rates navigating over the next 12 to 18 months?
I mean, whenever you're underwriting deals, like just with prices, we're always assuming that it's going to go like interest rates are going to go higher and prices are going to go down. So that's just the assumption. But personally, I think like interest rates are going to go up a little bit more and then come back down. But I mean, like I don't have a crystal ball, and when I underwrite the deals, I'm not assuming that. I'm just assuming that either stay the same or it's going to go higher. And so,
yeah, that's what we're doing too. I mean, we're obviously cap rates are going to go up in the short term with the way the interest rates were pumped there, but. Us too. We're like, hey, let's assume interest rates are going to remain high. And if the deal pencils, then let's do it. And because most likely interest rates will eventually go back down. It might not be a year from now. It might be 2 years from now. It might be 3 years from now, and that's okay. But if the deal pencils with the higher rates, then I'm okay with it. You know. So I don't know. We'll see. We'll see where it goes. How do we buy a boutique hotel out in Hawaii? That's what I want to know.
I mean, just put out offers, man. I mean, it's like the same way you buy a boutique hotel anywhere, right? You just got to get in touch with a seller who's willing to sell at a price that makes sense for both of you guys. And then, I mean, that's all it is. I mean, I'm trying to think off the top of my head. We don't have a whole lot of boutique hotels.
Dude, there was a really cool one in Kauai. I was out there and one of the locals said, hey, go check out this breakfast spot. It's a local breakfast spot. All the locals love it. And it's been around for like 60 years. And it was this rundown, like blue motel. It looked like they could be running prostitution out of there. It was that rundown. But you go into the bottom floor of this motel and there's this cafeteria. And you just go in there and there's like all these locals in there, like just like it was very mom and pop, but the best Loco Moco fried rice I've ever had. It was so legit, dude. It's called Tip Top in Kauai. For listeners out there, if you're ever in Kauai, go check out Tip Top. It says Blue Motel. It's so good though. The food was legit. But anyhow, there are some boutique hotels out there, but like what I found, at least some of the folks in our mastermind, one of them's in Hawaii. And then another one is out here in San Diego, but they're both kind of like looking at some deals in Hawaii, but like from what I found, or from what they're telling me is that a lot of these small boutique hotels out there, they only want to sell them to other locals. They don't want to sell them to mainland people.
There is something to that. I mean, so even as fix and flippers in Hawaii, I think we have a big competitive advantage just because we're local to Hawaii. And so like when we talk to sellers, I had another buddy who was like flipping in Hawaii, and he's like from California, and he's like a military dude, like the straight, like just like white, like, like young white. And so he said like a lot of times when he goes to like these seller appointments, he'll walk into the door and he'll see the people's faces drop because he's exactly what like I guess a lot of locals don't like. They're like young, white, and from the military, like and so there's a stigma. Like some of it is unfair, but then a lot of locals they like to deal with local people, and there's even within like Hawaii, there's like subcultures.
Did they call them crackers?
Not really. I mean, like
is there slang for like
they call them haoles. That's like the
white military dudes.
That's like, or just white people. We call them haoles in Hawaii. Yeah.
Okay.
But even within Hawaii, there's like subcultures. So there's the Koreans, there's the Filipinos, there's the Samoans, the Japanese, and like everybody kind of has like their little own nuances as far as like how like they view the world and deal with their cultures. And so like, but growing up, you kind of like it's a melting pot, so you're exposed to everything. So it's very easy for us to relate to the locals just because we're familiar with like what's important to them and how they see the world. So yeah, definitely.
And I totally get it. It's like you guys are isolated out there. It's like your own thing. It's like let's support the locals and let's let the locals have an opportunity to buy up this real estate versus a bunch of outsiders, dude. I totally get that.
Yeah.
You know, and you see that in the States, you know, a lot of these markets, especially the smaller markets in certain parts of the country, they want to keep things local. They want to support the local businesses, and they want to give opportunity to local people before they let outsiders come in and drive up the prices.
Yeah, no, 100%. That's 100% true.
I get it, you know. So with all the things that you're doing, man, like for a new investor out there that's maybe listening to the show right now, where do you suggest they get started? The fix and flip, Airbnb, go into the commercial space?
I think number one, I think commercial space is very hard to kind of start out with, just because it requires a lot of like capital and like a lot of resources and relationships that is very hard to start when you're just starting. But I think like fix and flipping or even Airbnb are both great ways to start. But so we have a lot of calls with like newer investors and say, hey, where should I start? But a lot of it depends on what is your resources you have available now? Like, do you have a lot of time? Do you have money? What are like are you good at like construction? Like, what are the parts of the things that you have inherently or the relationships that you have now that you can take the most advantage of? And for a lot of them, sometimes they're just like, hey, like they don't want to put in any time or they don't want to like learn anything. Like, just jump into a syndication or like that might be your best bet. But if you want to, so there's like the active route and the passive route, right? And so I think in the active route, maybe like Airbnb arbitrage or maybe like fix and flipping is a great opportunity. But on the passive route, I think maybe buying rental properties or being a private money lender on one of your deals maybe, or as a syndicate, and the syndication might be like the best avenue for them. So.
Yeah, I agree with that. I think it all comes down to like what kind of time you have left, and do you want to be active or passive?
Yeah.
And then from there, it's like, dude, if you want to be active, there's so many different ways to do it. And there's no right or wrong. I mean, there's 150 ways to make money with real estate investing, and they all work. I think it's just a matter of like sticking to one or two things long enough to where you can actually get good at it. Yeah,
100% agree. I think the other thing too is when you just start out as an investor is there's a long lead time before you get paid. Because I think like it's when you look at people's social media, it's, oh, I got $100,000 check here. I made this. I bought this. I became a millionaire in like 3 years, whatever. And so like it seems very quick as far as like what the progress was. But typically as a real estate investor, there's so much like knowledge, foundational things you have to build in the very beginning. And so you're spinning your wheels, you're trying to get your first deal. It's going to take like a year just to get your first deal, just because you got to put in all the work, the knowledge, and build the relationships and the network that's involved to kind of get to the next level. And then once you do your first deal, it's easy to get your second, to get your third. But it's always that first start that's really I think it's very it's a big hurdle to cross. Like a lot of people kind of give up before like
it's overwhelming too, and it can be scary for a lot of people. I know my first deal, I cashed out my 401k, and I was scared because everyone told me it was too risky. You know? Well, dude, I appreciate you taking the time to come on the show, man. It's been a pleasure chatting with you, and I know you're going to come with me to the Beers and Deals meetup here in a little bit. So excited to continue to connect. And Alex mentioned you're going out to Cabo after this, huh?
Cancun, Cancun with the wife.
You and the wife.
Yeah.
Okay, I was going to say, how long you guys been married?
4 years.
4 years. Congratulations.
Thank you.
Man. What's your wife's name?
Christina.
Shout out Christina, dude. That's awesome. Well, I appreciate you coming on, man, and excited to continue following your journey, brother.
Thank you. No, I appreciate it.
Listeners, thanks for tuning in. We'll see you in the next one. Peace.